Welcome to Ahead of the Curve. I'm Susan Lisovicz. Today we're focusing on math and how math never lies. That, according to my next guest, who is Stanley J.G. Crouch, who is CEO of EXP Wealth Enhancement, which is owned by Aegis Capital, where he's also Chief Investment Officer. Welcome, Stan.
Thank you, Susan.
Now, you say that a perfect example is Europe's massive debt crisis, that actually you could figure it out quite easily how this would never be sustainable. So give it to us.
Well, sure. Everybody knows about the factor of compounding that we all learn actually in grade school. The geometric progression of a number, 1 plus 2, 2 plus 2 is 4, 4 plus 4 is 8, 8 plus 8 is 16.
Bigger and bigger.
Exactly. So it doesn't get too much longer. It's like if you double a penny every day, by the end of 30 days, it's millions. So if we think about that...
In trillions.
Right. Isn't trillion the new billion, which used to be the new million? So the numbers get very, very daunting. A lot of commas used, right? So what we're really talking about is this exponential effect on somebody that's having trouble, struggling, like Greece, where because they're struggling, they have to pay more in interest costs because people are afraid of them being able to pay it back, so they raise the rate that they charge them. But it's worse for Greece than even that because they're actually borrowing money to get to the next borrowing. So it's really just an unsustainable issue.
I think that if this were a person or a household, we'd say they're bankrupt.
Yes, they would have called an 800 number a long time ago.
Okay, but I mean, isn't that only fair though? If you are more of a risk, you should pay higher interest. If you have this long established history of paying your bills on time, of being very stable, then you should get the prime rate. So, I mean, you're not offering an alternative here, are you?
To some extent, because we actually, now that you mention how a credit, for instance, is graded, we actually look at the rating system as being our best friend. Because within that...
You are a man to yourself on this one, because the rating agencies have not been given a lot of respect lately.
Well, look, they've made some well-publicized mistakes, particularly leading into the subprime crisis, and many people blame them for actually creating the crisis because the truth is they rated things AAA that it was sometimes within months went to zero. So obviously that's not riskless or highest grade. The same way they had a role in the European debt crisis. Greece, for instance, was A2 rated by Moody's in 2009. And when it became apparent that Greece maybe was starting to have some difficulties, the first thing Moody's did when they downgraded them was to downgrade them to A3. But A3 is still a pretty good.
Still
high
pretty
rating.
good for where it's at. So where do we go in terms of then looking at the rating agencies as our best friend?
Well, because what we do within the rating categories, I think people need to understand what the function of the rating agencies really is. Rating agencies are actually sanctioned by the government. They're given a license by the government to be considered valid ratings in all manner of investment programs. So endowments, pension funds, mutual funds are bound by strictures or requirements that require the manager, particularly in fixed income bonds, to buy different rating categories in different percentages, thinking that that is a less risky way to go. So since you and I could start a rating agency tomorrow, the Susan and Stan agency, we could even charge and get paid considerable sums for rating credits. We're not acceptable to the federal system, so therefore we're not sanctioned by either the U.S. government or the international authorities that regulate the rating agencies, so our opinion in effect doesn't matter. So because portfolio managers are bound by this system and have to fill these buckets of the different rating categories, and when I say that I mean investment grade, BBB or above to AAA and everything in between, that allows an investor, if they know the fundamental credit and they do careful analysis of that and its sustainability going forward, to take great advantage of that because you get more yield in the lower rating category.
The higher the risk, the more interest that you're paid if it in fact works out.
Right, but who determines the risk? If we let the rating agency determine the risk, then yes, but we determine the risk and we find great values, bargains even, in amongst the medium and sometimes no ratings at all, because there's lots of reasons why a particular borrower wouldn't get a rating. Either the size of the issue, maybe it's a new project, maybe it's an add-on to an existing project, but it's not part of that guarantor, but it has, say, collateral value. There's different reasons why somebody would be non-rated.
Right. But getting back to your point about how the math never lies, you want a better return. You as an investor want a better return. So you don't have to go for the AAA rated in terms of, as an investor, you might get a better return. Is that what you're saying?
Yes.
How do you find what's going to give you that great return?
Well, you come to EXP Wealth
Enhancement.
Enhancement.
There you go.
Because we do things differently. We use the math to our advantage. So you're correct. If you get a higher return and you are committed to a reinvestment program where you compound and be the beneficiary of that exponential effect to your wealth over time, you'd be surprised how the math works. For instance, you could even have an onerous default rate over time and still benefit tremendously more than, say, AAA. But people don't think of it in those terms. There's one thing about AAA. Because it's perceived, and it's more than just perceived, it's actually codified as the highest quality, it also is the lowest rate of return. Mm-hmm. But that doesn't mean it's riskless in two ways. One, that the rating itself may be suspect, as we found out. Two is, because you're getting the lowest return on a current income basis, you're less able to get that wonderful effect of the exponential compounding over time.
Which is why so many people put their money under the mattress these days.
Yes, but then they get effectively zero. That also entails a risk, because not getting a return on your capital is in itself risky because you're not growing your wealth.
Okay, so all right, we're going to you now, Stan. So where are the fines then in terms of bonds that are not AAA rated, or instruments, I should say, that are not AAA rated? Is there an area at least that you would advise people to start looking?
Sure. What we look at two particularly important factors among many, but our two main drivers of why our selection process is what it is that we have security. So in other words, if the borrower cannot pay, what happens? Is there collateral? Is there something to attach to? Do we have a pledge of, say, real assets like property, plant, equipment, endowments, cash?
So that's how it could default and you'd still be paid?
Yes, because we have collateral. There's something backing our loan besides just the promise to pay. That's one thing. Is it secured by something real? The second thing that we do is we look at the sustainability of that cash flow stream. So what we try to do is say, what are the metrics of that entity's ability to pay the interest back? In other words, we don't buy or own any U.S. Treasury bonds because if we look
They're no longer AAA rated. Right?
Well, it's not just that. AA plus is a high rating. What we look at is it doesn't meet our credit qualifications because the federal government operates at a deficit on a current cash flow basis, and its balance sheet is really not very good.
Sad.
So
that's a sad statement.
We look at it as an isolated situation. If that was a project that we were looking to finance, or a corporation that was coming for a borrowing that was going to pledge their collateral to us, it wouldn't qualify, so why should we buy treasuries? In addition, we get the lowest rate of return, and depending on how long of a maturity date, we're also taking tremendous risk in interest rate risk, because if rates go up and treasuries are very low yielding, then we're going to suffer tremendous losses, at least on paper, unless we hold them to maturity.
So what are our choices as an investor? Do we, if we can't go to you, Stan Crouch, who has it down on the value of compounding, then do we go back to our third grade math class and start compounding again? Do we go back to the future?
In a way, I think we do have to go back to our third grade math class because we have to change the nature of our conditioning. And the conditioning's occurred because the financial services industry has taught us their version of how to invest. And it's really a new phenomena. It's only 3 or 4 decades old that this process has been really enforced. Now, in our grandfather's era, they did things a lot differently, and for many centuries before them, because they looked at something as an investment if it paid a tangible cash-on-cash return. If it didn't pay a tangible cash-on-cash return, then it was a pure, what it is, speculation. And we don't want to speculate because we don't need to. We can get great returns with a lot more certainty. So that's what we do.
So in just a couple words, we'd say, do the math.
Do the math and recognize the incredible power of the exponentially positive effect to your wealth of compounding.
Stanley J.G. Crouch, who is CEO of EXP Wealth Enhancement, owned by Aegis Capital, where he's CIO as well. Thank you so much for joining us.
Great, thank you.
And you've been watching Ahead of the Curve. I'm Susan Lisovicz. We'll see you next time.